The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, over 90% of retail traders fail to achieve consistent profits. So what about the remaining 10%? What separates successful traders from the majority who struggle in markets? Is it all just luck, or is that just a misconception? How can one develop the right trading mindset, manage risks effectively, and build a sustainable approach to trading? How can we start 2025 on the path to smarter trading? Well, to find out more, joining me now is Lim Jun Kit, who's a senior strategist at Phillip Nova. Jun Kit, welcome to the show.
Hi, Hongbin. It's been a while. It's great to be back.
It's great to have you on again, Jun Kit. Let's just start off with, identifying some of the key differences between being a trader and being an investor. I mean, how can one determine which one they'd like to be before they'd start their investment journey?
Yeah, but I think that is a great question to begin this conversation today, because trading and investing, these two words are sometimes used interchangeably, but there are certain key differences between both. So investing is more of like a longer-term buy and hold kind of strategy, whereby the goal of that is to achieve capital appreciation. At the same time, you're also able to achieve some dividend income through that. And so some of the popular products that people invest in are things like stocks and exchange-traded funds, ETFs. Trading, on the other hand, it is more of a shorter-term strategy where you buy and sell a different kind of financial instruments to profit from the price movements. And some of the popular contracts that a lot of retail traders are trading are things like Forex, spot gold, and contract for differences, which is actually a derivative on a wide range of assets like stocks and global indices. Now, so in short, trading requires a lot more active management as compared to investing. I would say that investing is no doubt more suitable for the masses because it takes less time and effort to be engaged in that. So if you're looking to actively participate in the market and you're also hoping to maximize your returns beyond what the benchmark S&P 500 ETF can give you, and very importantly, if you have the capacity to dedicate time and effort into mastering this craft, then trading may be something that you can consider.
I see. Well, trading in the financial markets holds the allure of potential riches, right? But the harsh reality is that over 90% of traders end up failing. So why do most traders fail? Are there common behaviors or mistakes you see repeated?
So here's the thing, most traders, when they first start out trading, they don't realize one thing, which is the fact that in trading, at least in the very beginning, it is a loser's game. Okay, so there are two types of games. There's winner's game and there's loser's game.
Right.
So in a winner's game, a player would play the game and win the game by displaying incredible skills. So something like in a Counter-Strike game, in a shooting game, you'd win by scoring the headshot. Well, loser's game, on the other hand, it is a game where you win by not making mistake. Yeah, so have you watched Squid Game?
Yes, I have.
Yes, the first game that they play, I think red light, green light. Yeah, so that is a very good example of a loser's game whereby you excel in the game by not making mistake.
Yes.
Okay, so a lot of people, they get into trading right away, treating it like a winner's game, but they lose sight of the very important foundation skill of not making mistake. And by avoiding this mistake in the beginning, you'd actually be outperforming majority of traders. Yeah, so I think as you manage to get better at protecting your capital when trading, so this is when you can potentially turn this losing game, this loser's game, into a winner's game where you can refine your trading strategy and hope to make a profit from there.
I see. Well, nevertheless, there are different types of trading strategies, right? Some even claim it as a so-called winning strategy. Now, if there are proven trading systems, why do so many traders still struggle? Is there such a thing as a winning strategy? And what are some of the misconceptions people should be aware of when trading through such strategies?
I think it's also a very good question. Any trading strategy, like even the best ones out there, it involves risk, which means that it is part and parcel of the trading strategy to have losing trades and also winning trades in between them. So it is just really part of the probability game of trading. So making a loss doesn't sit well with a lot of struggling traders because they are reluctant to accept and to face it, because it's about losing money, right? In a natural sense, who would like to lose money? If I drop a $10 bill on the floor, I lose it, I'll make sure that I forever keep my pockets tight and never lose a bill again. But in trading, the concept of a loss is actually really counterintuitive, whereby if trader knows his trading strategy well, he will be comfortable taking trading losses because he understands that losing trades is part of the trading strategy, and through his own data and statistics, right, he understands that the winning trades that he will get from his trading strategy would eventually make up for the losing trades and netting him a net profit at the end of like a series of trades. Okay, so a winning strategy could be making a lot of money to an experienced trader, but if you hand the exact strategy to a struggling trader who doesn't yet understand the nature and the role of losses in a trading strategy, then they wouldn't be able to manage it. Like as soon as they meet one loss or two losses, and they'll be too afraid to take another trade. And worst of the situation is that they'd be making like mistakes, emotions would come in, and that's how even with winning strategy, some traders who don't understand this concept would still not be able to let the winning strategy play out.
I see. So how does trading work exactly then? What are some things traders should consider before starting a trade?
So trading, I would say like a business, like a lot of professional traders, they would say that as well. So in a typical business, you have your revenue, right? And you would also have expenses. So you take your revenue, you minus your expenses, that is where you get your profit or net profit or either net loss. So in the revenue in trading is going to be your winning trades. Right. On the other hand, the expenses of this business is your losing trade. Like you cannot operate a business without any expenses. And losing trades is an expense in a trading system. Okay, so the objective of a trader is to be able to identify a strategy, a clearly defined strategy that gives him or her an edge over time with a certain win rate. Okay, so let's say if I take 200 trades, so like 50% of that is a winning trade, 50% is a losing trade, then I have a 50% win rate. Okay, so here comes the key component, right? So it's 50-50, 50 win, 50 lose. But during the 50% of the time that you lose, a trader makes sure that he only risks a certain percentage. So let's say a figure like $100. Okay, so when you lose $100. But when you win, your target level is at least going to make it $200.
Okay.
Yeah, so 50% of the time you lose 100. And the other 50% of the time, when you win 200. So in the long run, across a series of trades, it's a fair game, right?
Yeah.
Use some positive profits. So that is what we call the risk-reward ratio. Okay, and a lot of traders, when they first start trading, they place too much attachment to individual trades without looking at the bigger picture that it is a numbers game.
Right.
Okay, so by focusing too much on individual trades, they hope that, with one lucky trade, I'm able to get rich, I'm able to get a lot of money. So that introduces a few problems, right? Which means that they will be taking a trade that's too large, therefore subjecting them to large of a risk. And secondly, they would also be very reluctant to accept their losses. And, even though when it's just beginning to be a small loss, they don't want to accept it. And they let it, continue run, and they end up making a loss that's larger than necessary. Okay, so in reality, once again, I think it's very important for traders to be aware that to look at a big picture where success in trading should be measured across a series of trades and across a period of time instead of just trying to hit it once and get rich forever. So I think you can be losing half of the time, right, like what I mentioned, but with the right risk and reward ratio in your system, you'll still be profitable at the end. So now, having that said, right, losses are an integral part of any trading strategy. So risk management becomes a really essential pillar in a trading system, in a trading strategy that must never be overlooked.
Right. So you talked about the risk and reward ratio, and to take a look at the bigger picture and losses, it's inevitable. So let's talk about risk management here. I mean, risk management is a big word, but may sound vague at the same time. So could you share some practical risk management tips for traders?
Yes, I think risk management is really the ultimate skill that a trader needs to master. Like you can learn all about fundamental analysis, you can learn all about technical analysis, trend line, like mastering entries and all that stuff. But without risk management, all of that is really just useless, right?
Yeah.
And a lot of traders that we speak to, a lot of professional traders that, have a full-time living, make a full-time living based on trading, their main principle is capital preservation in trading is key. But when you speak, because we organize a lot of talks to a lot of our clients here at Phillip Nova, and we will tell them that capital preservation is key, and you have to abide by certain risk management measures. But then they would just go off it as then I'm trading so little, then how am I going to make money? So trading is very counterintuitive in many senses, whereby the more you think of making money, the faster you're going to lose money.
Right.
Yeah, so it's very important to have that capital preservation as the main objective in mind throughout your trading journey, and especially important when you're first starting to trade. Okay, so back to the question is, what are some practical risk management tips? There are a few simple tips. So the first one is that whenever you place a trade, you need to always set a stop loss on your trade. Always. So imagine, we need to make sure that our losses are smaller than our winners. A lot of people, you'll be surprised, a lot of traders, they get into a trade and they just don't set a stop loss. They will just let it run against them and they hope that it's going to turn back in their favor. So yeah, that's unfortunately the truth. And by having this strategy or having this stop loss in your trades, you'd be saving yourself from a lot of hefty losses.
Right.
So this stop loss level should basically be set at a level which would, let's say if prices reaches this level against you, it would invalidate your initial view of that trade, right? So this is where you need to accept the losses and move on. Stop loss, firstly. And secondly is that, so let's say if you open a trading account, let's say you put in a few $1,000s in there. One of the key rule of thumb is to never risk more than 1 to 2% of your trading account in a particular trade. Okay, so let's say if you're just risking like just 1% on one trade, right, you could be losing 10 trades in a row and you're only down 10%.
Right.
Yeah, so a lot of traders, they don't set their stop loss, right? And then they don't calculate the lot sizes. So back to the second point, right? How do I make sure that I only risk 1 to 2%? It's by taking my entry level and my stop loss level. That difference, I calculate into a proper lot size.
Okay.
So in that kind of lot size, if it goes against me, I know exactly how much I'm losing. So I wouldn't be losing more than what I wanted to risk in the beginning. Okay, so thirdly, it is also to, back to the point that I made earlier, is to always have a risk-reward ratio of maybe at least 3 to 1. Okay, so did you know that with a risk-reward ratio of 3 to 1, right, in your trading system, you can be wrong 70% of the time, like 30% of winning trades, 30% of losing trades, 70% of winning trades.
Okay.
And you still be profitable. Yes. So I'm a believer that, everybody says that you have to pay market tuition fee when you trade. That's the truth. Like everybody pays market tuition fee, but ultimately you can decide how much you want to pay. And by mastering and realizing by knowing this risk management measures, that's how you control how much market tuition fee you pay.
All right. So, Junkin, this begs the question now, the $1 million question. What sets successful traders apart then?
Actually, there are many, many things that sets a successful trader apart. But for the context of this discussion, I'd say that successful traders, they're obsessed with developing and improving their trading strategy. They are more focused on mastering the skill, like to find that strategy that works for them. They know their trading system, and they just master the process of getting a trade, getting out of the trade, how they manage your positions, and they look at it as a whole. And the strategy that winning traders would tend to have, it should be objective, it should be clearly defined, and you should be able to repeat it.
Okay.
So let's say if I get into the market today, I trade, and I make a lot of money. It's lucky, but can I replicate it? The answer is no. And the moment I try to do it again, the chances are I'm going to be in the red, I'm going to lose a lot of money. So being focused on crafting that strategy and looking at the big picture plays a huge part. And also, secondly, I think having that trading strategy in mind, right, then successful traders, they would be more comfortable to cutting their losses quick and then to let their profits run. Okay, so here's the key difference. So winning traders, they would cut their losses quick, let their profits run.
Yep.
But losing traders, on the other hand, which I think unfortunately is the most of the people, they take their profits very quickly and they let their profits run. Yeah, so you could be winning like 10 trades, but you have only need one losing trade to wipe out all the profits that you made from those winning trades. Yes, so I think that is a key difference. So traders, do cut your losses quick and let your profits run.
I see. So don't be greedy in another sense, right?
Yeah.
And before we let you go here, Jun Kit, for someone starting their trading journey in 2025, what's the one piece of advice that you'd give them?
There are many advice that I can give, but if I am to give an advice to someone who's starting new, I think having a realistic expectation is very, very important. Okay, so with that correct expectation, it sets everything in line. It calibrates your action to prevent you from doing things that subject yourself to too much risk, and just to take a more practical approach towards it. So my advice is, so let's say if you're starting to trade for the first time, you're a new trader this year, For the first year, you should aim to make a return of 0%.
0%? Why is that?
0%, yes. This is the reaction that we always get, to our clients, to the people that we speak to. Just imagine. The hard truth is, majority of traders, they lose money trading. Right. And the fact that you're able to trade in and out, months after months for the whole year and still not lose money, doesn't that make you better than majority of traders?
Oh, that's true.
Yes, so I think it's also very important for us to realize that all of the profitable traders, they take years, 1 or 2 years of consistent learning and to sharpen their trading strategy to achieve profitability. So who are we to think that as someone new, we get into the market, we are able to beat S&P 500?
Yeah.
So for the first 1 or 2 years, focus on building the skill set of trading rather than try to make money. Okay, so one very practical advice is that you can start trading with a small account and, just risk 1 to 2% of that small account and focus on that percentage losses and win instead of the monetary gain or loss. So once you are able to make the constant 1 to 2% return, so let's say on a monthly basis, you're confident in your trading system, so that is when you can scale up your capital, which makes, maybe 1 or 2% per month is already a sizable amount. So, the first 1 or 2 years, 0%, aim for that. Don't lose money. That way you're winning. After that, you can maybe try to up your target to make maybe beat S&P 500, beat 10%, and so on. So trading is actually a long-term game. Okay, so if you put in the dedication to master the craft, the potential upside is really there, as there are really a lot of people, successful traders who manage to turn trading into a full-time career. And I think that gives them a lot of freedom. So I think I'd urge traders to first build the skills first, make the money later. Thank you.
Well, thank you so much, Jun Kit, for your time and your insights today.
Thank you.
Thank you. That was Lim Jun Kit, Senior Strategist at Phillip Nova. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.